You don't need to be a finance pro or get an MBA to learn what a balance sheet is. Balance sheet is like peeping through someone's wallet. Balance sheet helps us to peep into the company's financials, what company owes, or how it functions. So, in this video, we'll learn about what balance sheet is, what are the basic parameters which are needed to evaluate a company. We won't go into too much detail and complicated things. We don't need to be a CFO, it's just about the simple things. So if we learn those simple parameters, we're just good to go. So balance sheet has the main definition, which is assets equal to liabilities plus equity. This is the core definition of a balance sheet. Now, balance sheet assets means what the company owns, liabilities mean what it owes, and shareholder equity, what's left for the owners. So, here we'll take example of Tesla's balance sheet. This is Tesla's balance sheet of 31st March 2025, 30 June, 31st December, and 30 September. So, I hope you are really familiar with that there are 4 quarters in one financial year of 3 months each. Let me tell you one thing more. Often we have heard this word income statement. So how income statement differs from balance sheet? Income statement tells about the company's performance during a period of time, and a balance sheet tells about company's wealth at a specific point of time. So we'll keep this video till balance sheet. Now this is the Tesla's balance sheet of October of March. Now see, there are many terms, and I'll just explain what the term means and how we can further evaluate the stock. And there would be pure understanding and no fluff. So, total assets. This is the everything what Tesla owns, from factories to inventory to cash in the bank. And now, in this total assets, the two things are current assets and non-current assets. Current assets means which can be converted into cash within a year. So this can include cash and short-term investments. This is like Tesla's war chest, instantly available for salaries, emergency, or expansion. Inventory, unsold cars, raw materials, batteries in warehouses, and receivables. This is the money that people owe to Tesla. For example, Tesla has delivered the cars, but people have not paid the money yet. So, or maybe likely from partners also, or some vendors also. So, current assets is equal to short-term liquidity. It tells how well a company can survive in a crisis or pay upcoming bills. Now, non-current assets. Non-current assets means it holds long-term value. It cannot be converted into cash within a year. This might include net PPE, property, plant, and equipment. These are gigafactories, machines, solar panels. This is the backbone of Tesla's production. Next is goodwill and intangibles. This is also the part in non-current assets. So, what's Tesla paid over big book value when acquiring a company? So, for example, if you go, I hope you get $100 million. If you go and buy a company of $100 million, but you pay 25 million extra. So, if the company's market cap was 100 million and you paid 25 million extra, it means 25 million is that goodwill. So, it's the premium paid over company's net assets. Now, Tesla's goodwill is 392 million, which is very low for such a huge company. So, that means Tesla hasn't been overpaying for companies, and their growth is mostly organic. Now, let's see what Warren Buffett says about goodwill. Goodwill can hide failure. If the acquired liabilities don't perform well, that goodwill becomes worthless. Now, one word I forgot to cover: intangibles. It includes things like payments or patents or trademarks. So, remember one thing: goodwill inflates the balance sheet. So, the company should be really good And if the acquired business doesn't perform good, then the company or the goodwill becomes worthless. And there's no benefit in inflating those numbers except for fooling the people. Liabilities. Liabilities, current liabilities is 29.75 billions. So, as I said, current assets can be converted into cash within a year. And this current liability means it should be paid within a year. So, account payable, Tesla's unpaid bill to suppliers. See, Tesla doesn't manufacture everything. There are some parts which it gets through vendors, suppliers. So, this is the unpaid bills to suppliers, short term debt and leases, and deferred revenue. Money Tesla has received but hasn't delivered services yet. There is one more thing to it, accrued liabilities. Now, accrued liabilities, these are the expenses Tesla knows are coming but hasn't paid. It can be salaries. Now, I was wondering what does accrued expense means? And if it hasn't been paid, why it is shown in the balance sheet? So the thing is, the company was supposed to pay in that quarter, but the company did not pay. But if that was supposed to be paid, that's why it was shown. That's why it is shown in the balance sheet. For example, accrued liability can be salaries also. Maybe it hasn't paid salaries to people. So, a company with long-term debt and healthy growth. So remember, low long-term debt and healthy growth. These are really investment friendly. Now, we have covered two things: liabilities and assets, which we were talking about the core definition. Now, assets equal to liabilities plus shareholder equity. Now, shareholder equity, this is what's left after paying all the debts. So if Tesla shut down today and sold everything, this is what is left for shareholders. Now, see, the thing is, we have covered the basic parts, and I won't complicate things. This is the needed thing for just initial investors. And in the upcoming videos, I will try to cover more things and more technical stuff. And this next part will be moving to important ratios. See, there are many ratios: price to earning, EPS, ROAS, EBITDA, everything. But in this video, I'll keep it to balance sheet and just 3 4 essential ratios which one can calculate and judge a company and its stock. So, one is current ratio. Current ratio is current assets upon current liabilities. So, I told that current assets which can be converted into cash within a year, and current liabilities which need to be paid within a year. So, it is 2. That means, can the company pay short term bills? So, ideally, range should be 1.5 to 3. Let me tell you something. If See, the game is of numerators and denominators. Assets should be high, liabilities should be low, debt should be low. So, about assets, what if assets are really less and liabilities are really big? So, the denominator increases and the current ratio decreases. That means that the company cannot pay short term bills easily. Now, if it is high, then it means that the company has idle cash. Now, the problem with idle cash is, for example, you have a company or I have a company. We have $100 million, $200 million, and our company is worth 300 million. Just for an example, that means we don't have a good vision, or we are not expanding enough. We are not investing in R&D. We are not investing in factories, infrastructure. So, too much idle cash is a problem, and not having idle cash is also a problem. So, one should take a midway. Debt to equity ratio, total debt upon shareholder equity. This is also the game of numerator denominator. Debt should be low and shareholder equity should be high. Now, let me tell you, this last term which we talked about, shareholder equity, this is what's left after paying all the debts. Now, this includes two things: paid in capital and retained earnings. So, paid in capital is the money which the investors put in, and retained earning is Tesla's accumulated profit. This is the shareholder equity. So, if equity is rising, that means company is creating value. Now, debt to equity ratio, total debt upon shareholder equity. So, that is this, equity is this, the ratio is 0.18. So, how much debt is used compared to owned capital? Now, the thing is, I said that numerator should be low because there is debt in it. Now the thing is, if it is absurdly low, then that's really good because shareholder equity increases, and that means that the company is at low risk. But ideally, there should be no debt. If it is zero, then it's the best thing a company can have. And two or three, debt to equity ratio is highly leveraged. It is risky in downturns. It can hamper a company in case of economic crashes. Next is book value per share. It is equity by shares outstanding. So, equity divided by shares outstanding. Now, let me tell you something. This is 23. Now, just for example, a share is trading at 30 and it is showing that it is 23.2. It should be 23.2. That means the share is overvalued. Mind it, this is not a single parameter of judging the intrinsic value or is the share overpaid or underpaid or over-evaluated or under-evaluated. But this is one of the parameters. So one can look for this. In upcoming videos, we will discuss more parameters and see about valuations, see about ratios, see about how investors invest, these kind of things. Next is working capital. Working capital is current assets minus current liabilities, which is 29.6 billion. This is the cash buffer after paying liabilities. It should be positive and growing steadily. See one thing. What if the debt grows at 10% or liabilities grow at 10%, and what happens if assets grow at 40 or 50%? Then I guess debt is not a problem. So debt can be ignored in that case. Mind it, the company should lower its debts, lower its liabilities, increase its profits, assets, and everything. So next is debt ratio. Debt ratio is equal to liabilities by assets. It shows what percentage of assets are funded by debt. Ideally, you should not have any liabilities, but if it is less than 0.5, that means a company is stable. If it is more, then that means that the assets are funded by debt. That means in a downturn or in crashes, it can hamper the company. So now final analysis. For beginners, this was everything which was needed. You can obviously learn more. There are many books, and in the upcoming videos, I'll also teach about evaluating a stock and a company. So, final analysis. Are assets more than liabilities? Yes. Does Tesla have enough current assets to cover short-term debts? Yes. Are intangible assets a small portion? All that goodwill, patents, trademarks, are they small portion? Yes. So most of Tesla value is real stuff and not inflated numbers. Does Tesla have low debt? Yes, which means less risky if the economy crashes. Now you don't see just a balance sheet, you actually understand it. So Tesla's real quality: growing retained earnings, low debt, huge working capital, conservative goodwill. That means solid, stable, self-funded business. I hope you understand it really nicely. And in the upcoming videos, we'll talk about valuations, the ratios, and what intelligent investor do. So this was my first video. I stuttered a lot, and I obviously stammered also. So I hope I'll make less mistakes in the upcoming video. Thank you so much.